So let's get started on part 3, where again we're looking at a different style of analysis, and this time we're going to be looking at moving averages. Now, moving averages are a very popular tool to place on your chart. You'll find many traders using these. There are multiple different types of moving averages, we'll discuss those later, but they're a very useful tool for your charts, going to help you in your analysis, help you in your trading. So let's get started, and first off, let's look at what moving averages are. So if we take the standard example of the bullish trend, where you have the ABCs to the upside, what you can use is this moving average to sort of smooth out the price. So yes, you do have those bearish pullbacks, but you're not making new lows, you're not ranging, you are just gradually making those higher highs and higher lows. So as the market makes its way to the upside, the moving averages smooth that price action out and simply has an upwards sort of smooth direction on that line. Of course, if the market was to absolutely go like vertical to the downside, we'll show you later that line can change and give you like an idea as to either the trend direction or also possibly support and resistance again. So another one of those tools that can be utilized in a similar sort of way as the first part, but just in a different sense. So here we can see a moving average that kind of smooths out that price as time goes on. So it kind of like removes the volatility, because this is just an example, right? We'll look at actual real charts later, but you're going to have spikes where the wicks are. You're going to have various smaller little waves in between those waves. Remember the fractal market theory. So it's sort of like just taking the average price as time goes on and removing that volatility from the chart. So if we look at this example now, where we had the previous one, remember I said that what happens if the market just dumps to the downside, right? This huge volatility, a massive red candle. Well, if we do get this, what's going to happen is that this moving average will start to turn around, because it's catching up on the price. And we'll get to that sort of idea in a second of catching up. But here you can see the market starts to turn around. Well, this moving average is lagging behind based on what period of moving average this is, which will make sense very shortly. So as the market starts to come back up, it moves down, starts to retrace, that moving average will start to catch up with that price action. And you can see that as we make that lower low, as the market starts to turn around and make that bearish A, B, and potentially C, we've now changed the direction of the moving average also. So when I say that it lags behind the price, there's various like ways of looking at a moving average. You can have a 500, a 200, a 50, a 20. And that sort of initial figure will be how many candles or how many sort of like time scales based on what time frame it is. Let's say this is a 1 hour chart and you have a 50 EMA. It's going to use the price action from the 50 previous candles. So therefore, as the price makes the recent move, it's going to take a little bit of time for that moving average to catch up. And therefore, it's very, very useful for sort of like cancelling out the noise, so to speak. But clearly, this move here is not noise. That's a serious move to the downside, starts to retrace, and by that time, it's going to start to move around as well. And that's why it can help you with two things, which we'll look at, which is A, seeing the direction of the trend overall, and also potentially acting as support and resistance in the same way as trend lines do as well, but just in a slightly different sort of look to it. So the longer the period, the longer it's going to take to catch up. So if that was like a 1 MA, no one uses that, but let's say it's a 1 MA, it's going to be sticking to the price. It's going to be sticking to the candles because it's using the previous one candle to make the calculation. If it was a 1000 moving average, which again, no one uses, it's too long, but it's going to take a long time for recent movements to be factored into that line. So sort of a 50, a 200, they're both very, very popular, but 50 is a popular one on the lower time frames. There's many different types. That's going to use 50 previous candles if it's a daily chart, 50 previous days, if it's a 1 hour, 50 previous hours. So as that next leg to the downside and pullback starts to occur, it will start getting factored in slightly later. And we'll see this sooner on a real chart. So what does a moving average actually tell us? We've sort of hinted on this already. There's two ways to use it. So the first way, like I said, is to detect the direction of a prevailing trend. So as we had before, we had a bullish trend, that the trend line was clearly moving to the upside. As the market starts to create the lower low and therefore lower high potentially, that bearish ABC, the direction of that prevailing trend does start to change. And that moving average will catch up to that price as it starts to continue moving on. Now, therefore, that's the first type, the direction of the prevailing trend and the potential change in that prevailing trend. Now, the second way to use it is a form of dynamic support or resistance. Now, when I say dynamic, if you have a level that's horizontal, that is the level, right? You can't really like choose a different level, otherwise it is not the same level, it's a different level. Whereas with like trend lines, with channels, with moving averages, because they're slanting upwards or downwards, there's no exact price where that level is. The market could come back and meet it at any point. So therefore it's a dynamic level, and it can act as support and resistance. And we will look at examples of that. They're not representing those horizontal lines, therefore they're sort of less like, they're less important, but they're still quite important on the chart. They're just less serious on a horizontal level. And they're acting sort of as mean reversion points as well. So what mean reversion means is that the average price, where sort of like the price resets itself, is sort of where the moving average is. And then when the price starts to get super volatile again and makes that extreme move to the upside or extreme move to the downside, price will often revert back to the mean, and that often is roughly where the trend line is. So if we actually just 1 second go back again and look at this, there you have the market moving upwards. There's the average price. The market makes an extreme move to the downside. Now that moving average is going to catch up, and as it starts to revert back to the mean, it can revert back to where that trend line is. So it's made the extreme move, needs to calm down a little bit, needs to reset before the next leg to the downside. And that's what we mean by mean reversion. So when price makes the most extreme deviations, we could revert back to that price. That's why it can act as support and resistance before making the next deviation, the next extreme move, or next C, you could say. So which moving average should you use? Like I said, there's multiple moving averages, and there's no right or wrong one, but you can sort of figure out as time goes on which one works best for you. But the two main ones tend to be the 50 EMA and the 200 SMA. So the difference between the E and the S there, the EMA is exponential moving average, and the SMA is simple moving average. So the exponential, the difference between the two is kind of technical, but the EMA factors in recent candles more than the SMA will do. So let's say you had a 50E and a 50 SMA. They would both use the previous 50 candles, but the EMA would put more weighting towards the most recent ones. Therefore, it's better for those like quicker trend changes. Whereas the 200 SMA is going to be more smoothed out. It's going to give equal weighting to all the candles, and obviously it's using more candles, using 200 of them, so a longer time scale, and therefore it's going to move less up and down and take longer to actually catch up to the recent price. More of a longer term sort of moving average. So therefore you can see the exponential and the simple, and the 50 and the 200 represent, like we said, the number of days, the number of candles depending on the time frame that factored into that equation. So we know now the difference between those two. You can then of course try them out in your trading. You could have both of them. Some people use a 20, a 30. There's different strategies, use different ones. You can imagine that if you're looking at the exponential, and you can see there that the exponential is giving more weight to the recent price action, and let's say you're using a 10 EMA, well, you're probably going to be, scalping on a lower time frame. So taking those really like short, quick intraday trades, your day trading. If you're taking longer term swing trades, it's not going to be a very useful moving average. It's going to be too quick to catch up. So you'd rather have a larger one, like a 50 or even a 200 SMA, to smooth that price action out more and act as support and resistance, maybe a little bit less frequent. So you have to make less decisions. And then you can see the overall direction of the trend without it changing too quickly. So 50 EMA, let's just stick to the 50 EMA for now and look at it for trend direction. So here we can see the market is moving in various trends in one chart. So we have the initial downtrend, which is then followed by a short-term uptrend, which is then followed by a downtrend and another uptrend. So you have ABCs coming down, ABCs back up again, and another ABC to the downside. So remember the fractal market idea from chapter 1. This might be just one larger downtrend, but within those downtrends on the higher time frame, the lower time frame is going to have changes in the trend based on the smaller ABCs. So if that's a bit confusing, go back to chapter 1, check out that fractal market idea again. So you have a downwards ABC, which is like the A of the higher time frame A, and then this one here, this ABC coming upwards, is just the B of the higher time frame move, the higher time frame correction, and then multiple ABCs to the downside here could be a higher time frame, just one C. and again to the upside. So it could be like a, an overall downtrend, but on this time frame, you have the market with the moving average slanting down, then back up, then back down, then back up, because this time frame is having multiple trends. So if you zoomed out, and let's this is a 1 hour time frame, you then go to like a 4 hour chart or a daily chart, you may just have one moving average just going straight down, because of course it's a fractal market. So the MAs can actually help you with that too, that idea, because then you can see how the trend is changing based on the time frame, based on the ABCs, with the fractal market idea. So what if there's no trend? Because we've looked at, of course, consolidation and ranges. Sometimes there's not really an overall direction that's happening. It's just chopping up and down. The moving average can help you with that too, because you can see on the left-hand side, the moving average is slanted obviously downwards, right? And you can see there's downwards ABCs. There's a direction to that trend. As you start to go sideways and you make roughly kind of equal highs and lows, there's a lot of chop. There's no real movement going on in any direction. The moving average is just sideways. So you can actually like identify the direction of this time frame's trend by analyzing that moving average. It can help you to identify it quite well. And then as the market starts to break above the range, well, it starts to slant back up again until it's going really, really like quick to the upside, because it's catching up with those really strong bullish candles, and it's really starting to have a very steep incline on that MA. So that's one very good way to use it across multiple time frames, is identifying the direction of the prevailing trend on that time frame. So let's have a look at that again here. So trend direction, you have just one trend now, because the market's simply moving in one direction. So therefore the MA on this time frame is just going down and down and down. Now you can see, so here are those two lower highs in this area. So where you have this circle and slightly to the right, the market does have a brief period where it kind of goes a bit sideways. And you can see how the moving average also goes sideways a little bit, doesn't last very long, and then continues to go to the downside. But overall, clearly a downwards trend, and there you have more lower highs making their way down. So it's just giving you that sort of like confidence that the market is still bearish. And if it was to start turning around, of course, the moving average would start to flatten out and then start to go back to the upside. There's a really great example of that in a second, of how that sort of idea works. So what about support and resistance though? Now, as we know, when the market starts to break through highs and lows and create different ABCs in different directions, the moving average, like I said, will start to flatten out and then catch up with the new trend, as we've already seen. So here we have a market moving upwards, kind of slightly sideways as well in some parts, but you have these lows, the market breaks down through, you then have where the market hits its resistance there. So if you look at the green candles first, right, you can see where that support is being given by the moving average. So it's not exactly in the same place, but it's roughly in that price. And the red arrows here, where the market retests as resistance and finds some resistance from that. So not every single time the market touches the moving average will it find support and resistance, but you know that it could do, and therefore it's just one of your many tools you can use, one of the many potential confluences. So on the very right hand side there, you can see how the market comes into it quite strong, hits that moving average, kind of reverts back to the mean after making a massive deviation to the downside before, big A, B, comes back to that area, and then moves away, starts to make a C. So that's the sort of idea there, as how all these different moving averages on various time frames can act as support and resistance. So let's have a look then of the idea, like what's like a live example of what this could look like. So if you break out from a range, you're obviously changing the direction of the trend, right? So at the moment, if you look at the white line, the moving average, you can see there is no slanting to it, there's no direction, it's going sideways. And you can also see by the highs and the lows of the swings that there's no overall direction. There's like slight higher lows, slight higher highs, but it's not an upwards trend, it's really just going sideways. So you can then box that range off. Back to the idea from the previous part, the ranges. You can box that range off, therefore it's consolidation, there's no real direction. Now what if this happens, right? So the market makes a big move to the upside. Well, that could be an A. It could be a change in the direction of that trend from sideways, or previously from downwards to sideways, back to up again. So it could be a bullish A. As that happens, the moving average will start to catch up. So of course it could happen over multiple candles, and as that occurs, the moving average will start to slant to the upside after being flat, because it's catching up because it's an exponential 50 with the recent price action more weighted than the previous price action, and starts to slant to the upside. Now, as the market starts to come back down, there's a level there. So now potentially this may flip, was previously resistance, may now flip as support. And you also have the 50 EMA roughly in the same place. So now you can see how you've made that kind of like big move to the upside. You may now revert back to the mean, back to the level, back to that sort of moving average price, where you could then get the next deviation away back to the upside for a C. So here you come back down for the B. As that's occurring, the moving average will keep going. And now you can see how it's meeting roughly in the same place. Remember, the word for that was confluence. So we have a confluence of the level and a confluence of the moving average. And therefore it could provide the boost or the floor for the next move, making that C to the upside. So that is moving averages. Of course, like I said, there's multiple moving averages you can use. They all act in the same way, but with different time periods, whether exponential or they're simple, different weightings. But you will find which one will work for you. The 50 exponential moving average and the 200 simple moving average, you're very likely to encounter the most. So I recommend starting with those, and then you can experiment with different moving averages as time goes on. There's also ideas of different moving averages crossing over. You know, if you have like a 50 crossing a 200, it's known as like the cross of death, as it's called in like traditional markets. That's another way of using it, but less popular, I suppose, than using it as support and resistance and actually detecting the direction of the prevailing trend. So that's all for this part. I will catch you on the next part and see you then.